Right now, leading the talk is going to be the three people who work very closely together in the tax side, which would be Andrew Schuneman, Joe Breen, and myself. We can give some introductions in a minute, but we want to start out with maybe some housekeeping things on how to ask questions and how to interact. We're trying to make this as interactive and as easy to use as possible. So we'll let Alexandra do that before we continue to talk a little more about the new tax bill.
Awesome. Hi, everyone. I'm just going to give a quick update of some housekeeping items. So along the top of the Teams meeting, you should see our bar here. So in order to ask questions, you can utilize the chat button.
I'm good, Neil.
Oh, quick, I'm just going to mute some. So if you want to ask questions, you can also raise your hand and we can call on you to kind of chime in and ask a question, make a comment. And then also just want to point out the camera and the mic buttons are here to come on camera, come off camera, on and off mute, and to change your camera and mic setting, the down arrows.
Everything's, everything's in with Greg. I got him everything he looked for, so let me.
All right, that's all my housekeeping items, so I'll throw it back to Peter to introduce our speakers.
Little bit of a loose, I would say, a format we're using. If you're not, unless you have a question, we ask for you to mute your microphone, because if not, we're all going to hear your conversation. So again, we have a pretty robust tax team in the construction area at Witham, but right now there's going to be three of us kind of talking about this new bill. So myself, I'm Peter Hilera. I lead the tax team for the construction group. I've been doing this over 30 years, and I am glad that everybody was able to come in today and kind of meet with us. Joe Breen is a tax manager out of our New Jersey office, Red Bank, and Andrew Schuneman is also a tax senior manager from our Red Bank office. Both work closely together, and we want to take a few minutes to talk a little bit about the new tax bill that is coming. Will affect all of us. So if we go to the next kind of slide, we can talk briefly about the agenda. We're going to give you some general comments about what we call the big, beautiful bill. Maybe go through some tax provisions that did not change. And then what we want to do is talk about business tax provisions and individual tax provisions that will be affecting everyone on this call. So we go to the next slide. So general comments, as anything that comes out of Washington, the bill is over 800 pages long, and it provides a combination of revenue raisers, tax cuts, and some permanent provisions that have varying effective dates, which we will review with you. From a cost perspective, it's supposed to cost an additional $3.4 trillion, but it's supposed to save $400 billion. But as we know how they score these bills, they might say one thing today, and then we'll see how it plays out in the next several years. But it's kind of a costly bill. But I will say it is more just than a tax bill. It also affects Medicare, nutrition assistance, phase out a whole bunch of energy credits. It increases funding for immigration and border security. It provides more than $150 billion for defense spending, more than $132 billion for border security, and more than $45 billion for immigration enforcement. So even though we're going to be talking about very specific tax provisions that will affect you and your business, there are a lot of other things that this bill encompasses. In fact, there is a change to the accounting method that you can use for residential construction contracts that was kind of buried down in the bill that we'll go over with you and explain how that might affect you. Now, some of the provisions that did not change, we can go to the next slide, are something called no limit to pass-through entity taxes. And that is a very technical term. It just affects how you can take deductions at a state level for state tax payments made. Now, if you're from Florida, it doesn't affect you as much, but as Andrew goes through the business provisions, he can explain how that affects other states, specifically New Jersey. Before there was this ability or suggestion to limit the state and local tax deduction at a C corporation level, but that has not changed, all right? And there was also this rumbling that there would be a higher tax for wealthy individuals. If you had adjusted gross income over 1 million or 2.5, an additional tax was going to be added. That did no change. And there is no change to the corporate tax rate at a C Corp level, which is 21%, and no change to the capital gains tax rate, which remains at 20%. The tax rates that are on the individual level, because a lot of the people here have either S Corps or partnerships, is affected, but not the highest rates, and we'll go through that when we talk about the specific provisions for individuals. Now we can go ahead to the next one, Alex. So let's kind of go through some of the business tax provisions that did change and will affect you. I don't want to spend a lot of time on research and experimental expenditures, what are called R&D. It is very difficult and challenging for a construction company to have an R&D credit. But if you do, there was this provision called Section 174, which the R&D expenses could not be immediately deducted and had to be capitalized and depreciated over time. That actually changed, and now you can actually deduct those expenses, which make it a lot easier from a tax perspective. We always want immediate deductions versus deferred deductions, because it certainly helps cash flow from a tax perspective. Now, if you did have these expenses that were capitalized, there's two ways of addressing them. If you are a small business with gross receipts under 31 million, for 2024, you can immediately deduct it, but if you do, you have to amend your 23 and 22 return. If you're a larger entity, the deduction really doesn't affect your 2021. Again, this is very specific, very narrow. And in my client base, I have maybe one or two clients that benefit from this when they have engineering, architectural departments, and they're innovating their construction process. So all I can say is that if you are subject to R&D, you can contact anyone from the tax team to go over these provisions for you. And if you have a question as to whether it applies to you or not, we'll be more than happy to discuss with you. Again, I wanted to mention it because there is a limited scope or limited availability or who it really applies to, but if it applies to, it's really something that you should look into and kind of get a little bit more information. Let's go to some of the other provisions from a business perspective, which I'm going to let Andrew kind of discuss. And you will note that we might be going at a little bit of a faster pace because there are a lot of changes that we're going to discuss. We are going to be recording this if you want to look at it later. We can send the slides out. And again, if anyone wants to have any further discussions on anything that we're not clear on, you can have your tax service team, you can reach out to them and they can discuss with you. Andrew?
Thanks, Peter. All right, so let's jump into bonus depreciation. As everybody knows, the TCJA reintroduced the accelerated bonus depreciation back in 2018 and increased the deduction to 100%. However, as you know, that's been phasing down the last few years and was scheduled to be 40% in 2025 prior to this new bill. The bill now reinstates the 100% bonus depreciation and makes it permanent. However, there is a date to be mindful of. The property has to be placed in service after January 19th, 2025, which coincides with Trump's inauguration date. So just be mindful of that for any property that was placed in service in early January, as it would not be eligible for the 40%, for the 100% bonus. Additionally, there is an election you can make to continue using the 40% bonus in 2025 if you so choose. That's really more of a planning thing, depending on, how you've planned your, fixed asset purchases and deductions over the years. That's election is still in place if you'd like to take that 40% deduction. But with many of our construction clients being fixed asset intensive, we do expect this provision to have a significant impact on our clients' businesses. The ability to deduct 100% of the cost of the shorter lived assets. Remember, bonus depreciation is typically only allowed for assets with a useful life of 20 years or less. But for those shorter lived assets, the ability to deduct 100% is a huge upfront tax savings. The one thing I will stress, though, is this is a timing difference between book and tax, and eventually it will turn around, as we've seen in some of our larger clients who took advantage of those large deductions while the 100% bonus in the early years was available. So just got to keep that in mind, that whipsaw will swing back around, and if you don't continue to purchase fixed assets, eventually that tax bill will come. But it is a huge, upfront savings in that first year now with this permanent reinstatement of the 100% bonus depreciation. Next slide. So 163J interest limitation. When TCJA was originally introduced, the 30% limitation calculation included an add back for depreciation and amortization, but that phased out in 2022, which essentially made the calculation EBIT, earnings before interest and taxes, right? So this new bill now puts the depreciation and amortization add back into play. That's going to be a huge savings with rising interest rates over the past several years, right? We've actually seen a lot more clients be subject to the interest limitation than they were, when the depreciation amortization add backs were there. So I would say this alone is going to be a huge savings. I actually recently did a calculation for a client to compare the tax impact. They were considering buying a new building. And I did a comparison of the old law versus the new law with the changes in both the bonus depreciation and the interest limitation, after a cost segregation study to bifurcate some of the costs into the shorter lived assets to take advantage of bonus. I found that roughly the $10 million building purchase would result in about $650,000 of additional deductions in the initial year under the new law. So the interplay between bonus and the 163J interest limitation is impactful. Okay, next slide. Okay, so this one's completely new, qualified production property. It's an entirely new term and changes the depreciation treatment for certain property. Typically, commercial buildings are subject to 39-year depreciation and are not eligible for 100% expensing. However, this new carve-out allows for 100% bonus depreciation for qualified production property. The term qualified production property is defined to include any portion of non-residential real property used as an integral part of qualified manufacturing, agriculture, or chemical production, or refining of a qualified product. Qualified production property does not include real property that is used for offices, administrative services, lodging, parking, sales activities, research, software development, or engineering activities, right? So it's a very specific carve out. And this applies to property that was placed in service after the enactment of the bill, so after July 4th, but before January 1st of 2031. You can go to the next slide. We have a little chart here. Yeah, so the production facility can be either brand new construction or acquired, as you see in the chart. But if it's acquired, it has to be the taxpayer's first use and can't be used in a qualified production activity by anyone prior to the acquisition, basically from 21 through 25. So you basically have to be acquiring property that wasn't used for production purposes prior to you acquiring it. So you're kind of changing the use of the property. And then obviously, any new construction, you'd be building it for that intended purpose. So Andrew,
I want to mention something here because obviously no one here is going to be constructing a building for your own use that is a manufacturing facility. You could, but that's really not typical. So why is this important to a construction client? Well, number one, if you do manufacture and you qualify, if you go out and you build a $5 million building, rather than depreciate over 39 years, you can deduct that building the day it was placed in service, right? You just got to meet this. It's such a huge benefit, right? Number two, everyone here in the construction industry is always looking for new opportunities, right? And I understand that every construction company might have its expertise. You might be an electrical contractor that works on residential, right? Or you might work on car dealerships. But I can guarantee you that if this is really going to take off, then there's going to be a lot of investment, hopefully bringing manufacturing back to the U.S. And if it comes back to the U.S., which is the reason for doing this, someone has to build those buildings, right? And that's the people in this room. So just keep your ears open for any new opportunities that you have clients or anyone else in the marketplace that would benefit for this. This is huge. If someone goes out there and builds an $80 million manufacturing facility that we understand is going to take a couple of years, but it falls within the time period, they can just write off $80 million their first year, or I'm just saying when they get the certificate of occupancy and it first starts operating. So it might create opportunities for some construction contractors to the extent they manufacture. We have one here in Florida, which is huge, and they do manufacture, right? And two, it creates opportunity from a market perspective. If that market does start an uptick and you have the ability to get those contracts, they're going to be more out there given the tax benefits provided. So you got to think of it that way, right? How does it benefit you going forward and what opportunities are out there in the marketplace for you to obtain new contracts?
Yep, great point, Peter. You can go to the next slide, Alex. All right, QBI, the qualified business income deduction. So obviously we all know about the 20% deduction. there was concern that it might go away at the end of 25 because that was when it was scheduled to expire. But actually, one of the initial bills that went through the House had a 23% deduction in it, but ultimately the final bill essentially just made the 20% deduction permanent. So kind of status quo there, no real change other than this small $400 minimum deduction that they've included down there at the bottom. You can go ahead to the next one. All right, so this is what Peter had referenced earlier, the 460E exception for construction contracts, right? So 460E was amended to essentially treat residential construction contracts the same way that home construction contracts were previously treated for long-term contract purposes. This means that any residential construction contract, regardless of the number of dwelling units, has the ability to use the completed contract method for the entire contract. Previously, residential construction contracts could only use the 70-30 method, not full percentage of completion. If not full percentage of completion, and they were subject to an AMT adjustment. So that's a big caveat there as well. So essentially that 30% deferral was subject to an AMT adjustment. This change now makes all residential construction contracts the same as home construction contracts. So you can now utilize CCM for both home construction and residential construction contracts, and there is no AMT adjustment. And then there was another small change for small contractors under the 31 million average annual gross receipts test. The window for estimated contract completion has been increased from 2 years to 3 years. So any construction contract that is estimated to be completed within a 3-year period, and if you meet that $31 million under gross receipts test, you're exempt from using percentage of completion as well. And you can use that exempt method, completed contract method, if you so choose.
So Andrew, one thing that I think we will have to look at is how do you change your accounting method, right? Because we have some contractors that are using the percentage of completion method, especially 70-30, right? But now based on this new rule, which we don't have a lot of clarity as to what a construction is it the general contractor or is it the subcontractor? We would take the position that is a subcontractor. So I think there's a lot of planning opportunities here if you look at your WIP schedule to really determine what kind of jobs you have. And if you feel you fall within this, then I think we need to have a conversation. Number one, can we take a sub who services these type of GCs that are doing these type of buildings, do a completed contract method, which means you just defer all of the income all the way until you actually deliver that contract. This is a deferral. It doesn't eliminate the tax, right? And if it does, what is the process for making that change? I will tell you that the IRS has not said what that process is. We'll try to figure that out as quickly as possible. But if you need to look into this, I think we need to have a conversation before the end of the year to determine how this can benefit you. One thing that I do want to, really emphasize here, what Andrew said, is that AMT adjustment. A lot of times what happens is you avoid regular income tax, but you have this thing called AMT, which now you have to pay it. What this is saying is, for that entire deferral, if you fall under this umbrella, you don't have to make an AMT tax payment, nothing. You just defer it all. And if you think about it, that is more money that you have currently for cash flow and working capital to invest in your business. So if you couple that with depreciation deductions and a lot of other things that are beneficial, you have a huge cash flow play here to figure out how you can fund some projects rather than go out and get some financing. So there's a lot involved with some of these rules, and you've got to go through the calculations to see if it makes sense for you.
Yep, exactly. And, like Peter said, we're not entirely sure at this point how this is going to be implemented, but, judging on how other contract methods are done, they're all done on the cutoff method, right? Which essentially means that once you start accounting for a contract one way, you have to complete that particular contract under that method, right? So we would assume that this would be the same. So if you have 70-30 residential contracts already in place coming into the year, you would have to complete those contracts under that same method. And then any new contracts, any new residential construction contracts that are entered into in 2025 could be accounted for under this new, essentially, home construction method and utilize the complete contract method. So the one thing we're not really certain of is if there's an accounting method change that might need to be done, Form 3115. So, more to come on that when the IRS gives us a little more guidance.
Hey, Andrew, there's a question in the chat, and I think we can easily answer it based on the rules. It says, are multifamily construction contracts considered as residential in this ruling? Multifamily for either apartments or condos?
I would think so, yeah.
Yeah, that is correct. That's the way we interpret that. Susan, you asked that question. Based on the way the law is written and the changes, it encompasses anything that is a residential construction contract, regardless of it's an apartment, a condo. Again, that's how we are interpreting. This was sneaked in there. There's not a lot of more additional, I would say, information from the IRS, but based on what we read, unless we have other guidance, that seems to make sense.
Yeah, I mean, that's essentially the difference in the definition between home construction and residential is the number of units. So once you eclipse that 4 units, it changes from home to residential. So they've essentially just stripped that out, and anything that's a residential contract, regardless of size, would now be eligible for a completed contract. And Alex, you can go to the next one.
Keep going, Andrew. You're doing a great job.
All right, so 179 expensing. The only real change here was an expansion in the amount. The threshold was raised to a maximum deduction of $2.5 million and a phase-out threshold of $4 million. So that essentially means that you can take $2.5 million of a depreciation deduction as long as you don't place more than $4 million of eligible property in service. So similar to bonus depreciation, but has slightly different rules than bonus does, right? Bonus you can take even if you have a loss. Section 179 you can't. So it is limited in that aspect, but there's also some state differences, right? Most states, if not all, don't allow the bonus depreciation deduction, where some states like New York do allow 179. So to the extent that you can take 179 instead of bonus for state purposes, it does make more sense. So this expansion should be helpful from a state perspective for certain clients. All right.
I will say there was another question in the chat. I'm not sure if it might have been about the past subject, but what about ALF or ILF?
Not sure what those acronyms.
It's healthcare, Andrew. I think we need to dig into that a little more. It's assisted living facilities and independent living facilities. I think we need to. I think it would depend on whether those actually qualify as residential under the current ruling, which I don't know off the top of my head, Peter. I'm not sure if you do. We would need to look into that and see how they're currently defined.
Yeah, I don't, Kim, and that's a very valid question. On the other ones, I think they're a little more cut and dry, just because the definitions under Section 460. That one I don't know. Again, that might be something that we might have to look into to kind of interpret and see if we can take that position, or just wait to see if there's additional guidance from the IRS. But I'm sure that question we'll try to get you an answer, before the end of the year, because it's going to be important just to figure out if the ALF or the ILF will qualify under the no 460E changes.
Go ahead, Alex.
So just to kind of go, and again, everyone can have access to these charts. So what are the effective dates? Because there's so many things changing. So the R&D expenditures that you can automatically deduct, that applies for anything in 2024, depending on the requirements, and then if you're a larger company, for 25 and 26. Again, this is very narrow specific. If you have a question that affects you, you can contact us. The interest expense limitation starts at 2025, right? And that's really key. If you have a lot of financing, there might have been the inability to deduct that. It would have been a deferred deduction, but as we've said, we'd rather have a current deduction to save on cash flow from a tax perspective than a deferred one. The bonus depreciation, and I had incorrectly thought it was 2026, but no, it's 2025. So anything brought into after January 19, 2025 applies. You can still make the election to do 40%. Let's go to the next slide. The qualified production property. Again, the building that you buy, or the building that you build, or the building that a client will build for $100 million, these are the dates when they're actually effective. You have to have the construction begin after January 19, 2025. It's got to be placed in service before January 1st, 2031. So there are some leeways there from 25 and 26. Again, these are just opportunities. I'm sure you hear more about it. The qualified business income, which is at QBI, remember, that's the one that allows you to pay no more than 29.6% on ordinary income rather than 37%. That increasing threshold and how it applies after 2025. And the reason for that is because that was sunsetting at the end of the year, but they have not extended that. Then in 26, you would have paid more tax. So this is just an extension, and it's a permanent extension. And then it's a 179 expensing. I want to make sure everyone understands when we say permanent. It means that the tax code is permanently changed, but to be honest, it's going to be as permanent as the next administration that gets into, as the major party or who gets elected next. So permanent until the next person, but you can count on not changing it at least for the next 4 to 5 years, hopefully. So let's go to the next slide, and the next slide just talks really briefly about the employee retention credit. Some of the claims, especially as claims after 2020, the statute of limitation for Q1 or Q2, they have been expired. They can't go back. But I just want to make sure that everyone understands that the IRS did extend the enforcement date for certain claims based on certain days. So, for example, Q3 and Q4 2021, they will not be paid, but there is an extension of really the statute of limitation where the IRS can look into it. And again, if you still haven't received your check, you've got to figure out, when you put the claim in, because now the IRS is stopping to pay some of them. There are some procedures that you can't to go back. And also keep in mind that there were a lot of bad actors out there promoting ERCs. So you might have gotten your money, but it's still up for grabs for the IRS to challenge that and come back and talk to you about it. Okay. So I think that's it. It talks about a lot of the business provisions. Let's move on to the individuals provision, and Joe is going to handle that for us and talk about it.
Absolutely. Thanks, Peter. This is probably a good place to pause for 30 seconds, though. We do have the time if we want to get any questions on the top of your mind for the business section before we transition over to individuals. If anyone wants to raise their hand, call on camera, say it, throw it in the chat. We'll just take a quick pause here to make sure that we're all good on the business side before moving on to the individuals, because we are going to change course a little bit here for the next half hour. Awesome. I think I might cut us short on the 30 seconds since no one seems to be fighting, so that's fine. So the first big individual change would be the tax rate standard deduction and the new senior deduction. So under the past change, the original TCJA lowered the individual tax rates, dropped the max down from 39.6 to 37, put in that increased standard deduction, and removed personal exemptions. All of that with an expiration date of 12/31/25. So all that was set to sunset at the end of this year. What the new bill did was it permanently extended those individual rate cuts, like Peter just said, at least until someone comes in to raise them again. The maximum rate for individuals is going to be 37%. It also subjects those inflation adjustments for the 10 and 12% brackets. That's a new change with this bill. The standard deduction has been permanently increased to $15,750 if you're single, or $31,500 for married filing joint taxpayers starting in 2026. That number will also be inflation adjusted, so each year that's expected to go up. It permanently eliminates those personal exemptions. It feels like forever since we've actually talked about personal exemptions because they haven't been around for the past 8 years now. It does provide a temporary deduction. This is that new senior deduction. So it's temporary. It's for 2025 through 2028. There's going to be a new $6,000 deduction for individuals age 65 or older. There is a phase out of 6% based on your income. So over $75,000 for a single or $150,000 for married filing joint, that additional deduction is going to be limited. And it does apply to spouses separately. So if you file a joint return, you can get an additional $12,000 deduction if by year end both you and your spouse are over 65 years old. So not a ton of changes there, just that new deduction. Really, everything else was just making old adjustments permanent rather than temporary. Alex, if you want to go to the next slide. Peter referenced this one before. This changed the SALT deduction limitation. This was a contentious topic during the debating of the bill. Both sides wanted changes made to this particular item. Under the old rule, the original TCJA limitation was a $10,000 deduction for state and local and real estate taxes. That was set to expire at the end of this year itself, that deduction. The state and local tax limit was increased under the new bill to $40,000 for joint or $20,000 for single filers through 2029. This is another temporary change. That amount is set to be indexed for inflation, whereas the $10,000 was not. but in 2030, it's going to go back to where it is today. It's going to go back to that $10,000 limitation for married filing joint, or $5,000 for single filers. There are some additional hiccups with the new increased deduction. It limited the limitation does phase out for taxpayers with an adjusted gross income over $500,000. So the mechanics of that is that the $40,000 is reduced 30% of the excess over that 500,000 until it hits the minimum $10,000. So basically, you can lose the 30,000 over that next 100,000. So if you make between $500,000 and $600,000, you're going to be somewhere between a $10,000 and a $40,000 deduction. Once you hit over 600,000, you're back to the same $10,000 limitation that's there. There's a nice example on the slide kind of demonstrating that math. And I do want to underscore the fact that this relates to the topic that Peter mentioned in the no change slide. They are still allowing the deduction for pass-through entity taxes. That's a big tax saver for the states that have them in a high tax jurisdiction. I know Andrew and I are based out in New Jersey. In New York, similar, you're allowed to deduct the taxes at the entity level, and then you get that deduction flowing through to you on the 1040 and a credit for the payment. So very, very important is there is still a benefit to doing those pass-through entity taxes. That was one of the questions when they were throwing around either potentially limiting it or raising the SALT deduction if pass-through entity taxes would become kind of obsolete. They're not. They're still very much an important factor and something that should be discussed during planning. So that kind of covers this one, Alex. And another one is the excess business loss limitation. This was something that came about with the old TCJA rules for an excess business loss for non-C corporation taxpayers. So we're talking about your pass-through entities. We're talking about your Schedule Cs, your partnerships, your S-corps, that you're allowed to deduct business losses to the extent of your business income plus a fixed amount for whether you're a joint or an individual file for a single filer. So if you're a joint filer, you can deduct up to the extent of your business income plus an offset of $626,000 to other income. That limits half, $313,000 for other taxpayers. The excess would then be treated as an NOL, a net operating loss. So that limitation then doesn't apply in the following year under the current law. This is set to expire in 2029 under the old bill. What the new bill did was it was part favorable, part not. It made this limitation permanent. So you are not going to have that sunset in 2029. So the excess business loss rules are here to stay. So going forward, if you have a business loss in 1 year that exceeds that 626,000 or the 313,000, depending on your filing status, it's going to continue to be limited and convert to an NOL. What's very important is that one of the proposals during the whole bill writing process was that they would then subject that loss to these limitations again in the future. That did not make it into the final bill. There was a lot of concern that you would only be able to offset business income in future periods, so you could continue to have large losses and never really be able to offset a great deal of other income. That's not the case. It does still convert to an NOL after that initial year that can offset other income as you move forward.
So Joe, let me. This is a lot, and you're probably thinking, well, how does this apply to my business? So let me give you a real life example. We had a contractor who got into a little bit of trouble and had a significant loss that year, right? Let's just say the loss was $2.5 million ordinary loss. Because of that, and to keep some contracts open, there needed to be an additional cash being raised, right? And this particular contractor did have some investments and had quite a bit of, I would say, unliquid, liquid assets, just stocks and bonds in an account due to bonding, right? So the contractor says, unbeknownst to us, hey, I'm going to sell all these securities, right? So I could generate enough cash to keep this going and also put some more in some projects. Well, he generates a $3 million tax gain, capital gain. That is a non-business, right? Even though you think it's in the business and it's there for bonding, it is a non-business gain. Now he's got a $2.5 million loss, and he's thinking, well, I'm not going to pay a lot of tax. Well, unfortunately, that's not how it works. Out of that $2.5 million loss, he could only offset $500,000 of that loss in the current year to reduce that $3 million gain, right? And now he is stuck with a tax bill much higher, and all he was trying to do was generate sufficient cash to keep the business going, right, and to fund some of these losses because of a bad contract. So it can affect you, right? It can affect you in a situation where you have a down year and you're trying to offset your net operating loss that particular year with maybe raising some cash from some securities that may have some built-in gains. So it does apply. So the point is that every time you try to do a large transaction like this, or you try to do something, you need to call one of us just to make sure that some of these rules, which are extremely obscure and you don't think about because there are no normal rules, won't affect you and then have to pay tax. Again, that 2.5 million that only he could use 500,000 to offset the 3 million capital gain. It's a deferred deduction, right? He gets to now take the balance of that the following year. But again, the point is, in all businesses, why do you want to defer deduction when a current deduction will help you from a cash flow perspective for tax? So just keep those things in mind that you've got to talk to someone. You know, what is it? 15-minute like Geico commercial, a 15-minute call can save you 15% more car insurance. You know, a 5 to 10-minute call to any of us can actually save you quite a bit from a current perspective. We could just structure it differently. We found a way to structure it differently to save that, but it was a little bit after the fact, and it was a little jumping around, and then we helped another contractor with a very similar situation to kind of avoid a situation like that after they called us.
And Peter, this rule might seem obscure now, but with the return of 100% bonus depreciation, the increased 163J limitation, you're going to see a lot more business deductions floating out there. So you may see this rule get tripped up more and more if you're able to drive tax losses on profitable businesses based on some of those other deductions that you're getting for tax purposes. So definitely keep this in the back of your mind. Just because you're able to take 100% bonus depreciation, it might not give you the full benefit this year. You might have to defer some of it under these rules. So that being said, I think we're ready to move past the excess business loss rules and into something hopefully a little less obscure. Yeah, definitely less obscure. Itemized deductions. So the old rule eliminated the miscellaneous itemized deductions. So some of the deductions that fell into that category, these are your 2% deductions. They're your tax prep fees, your safety deposit box fees, your investment advisory fees, just to name a few off the top of my head. Those deductions were eliminated for anyone who itemized deductions. That was set to sunset at the end of this year through the end of 12/31/2025. And then the limitation applied to overall amount of itemized deductions under the old rule. Under the new rule, that elimination of the miscellaneous itemized deductions became permanent, except they did throw in an expansion of itemized deductions for some educator expenses. That's really the only expansion. Everything else was just making the cuts relatively permanent. It also creates a new formula for itemized deductions that applies to taxpayers in the 37% bracket, which basically caps the benefit of those at 35%. So there's a slight phase out there on the itemized side. Other than that, it's pretty much status quo on the itemized deduction side of what we're used to now. It's just not going to expire. Next slide, Alex. Yeah, this was another really kind of hot button topic of the lifetime estate and gift tax exemption. Under the TCJA, that exemption was increased to $10 million, and that $10 million was adjusted for inflation. So by 2025, the full lifetime exemption became 13.99 million, which was set to revert back to about 7 million at the end of this year. What the new bill did was it permanently increased that lifetime exemption amount to 15 million per individual starting in 2026. And that number is also going to be adjusted for inflation. So that's going to continue to grow over time as we expect the inflation to hopefully flatten out, but as inflation continues, that'll continue to grow. Why this is very important is it kind of changes the narrative here. We reached out to a lot of our clients. I'm sure some of you heard from me, Andrew, Peter, talking about trust and estate planning, starting once we thought the sunset was going to happen, starting to look at that and take into account how you're going to maximize this exemption. Now, for a lot of our clients and taxpayers, that may not be as big a concern, because if you have two partners and spouses, you're dealing with anywhere from 30 million if you're married to 60 million for multiple owners of exemption to pass a business on to the next generation. So this really changes the narrative around the trust and estate planning a little bit, because it's less about the numbers and we have a little bit more flexibility to look at actual succession planning and develop a plan that makes sense for the business rather than just trying to maximize an exemption before it sunsets. So if you need any help with that, that's something we can definitely assist with. This was a big win in terms of being able to pass on businesses tax-free and do some of that succession planning at a more relaxed pace rather than trying to ram it through. So definitely a big ticket item there. So. Okay, now we went from a big ticket item in the tax world to one of the most heavily publicized campaign promises of the Trump campaign of no tax on overtime. So under the old rules, overtime pay was just treated like any other wages. It's taxable at ordinary income tax rates, nothing special about it. Under the new rules, this is brand new, there is a new above the line deduction for individuals during the 2025 to 2028 tax years. I'm going to kind of take this in pieces. So first part, it is temporary. It's only for 2025 through 2028, at which time it will sunset. And it is a deduction. It is not an exclusion from tax. That's very important. So they still need to be reported. I'll talk a little bit about that in a few minutes, but it is a deduction on the individual returns. There's going to be some additional tracking. It's for overtime pay in an amount up to a max of $12,500 if you're single, or $25,000 if you're married filing joint, but it can't reduce income below zero. So if you have other deductions or losses or items that are offsetting wages and driving you down to zero, you're not going to be able to take this deduction to drive a net operating loss. There is a phase out on this deduction. It phases out by $100 for every $1,000 by which your modified adjusted gross income exceeds either 150K or 300K. So for a single taxpayer, that phases out at 275,000, and for married filing joint, it would just be double that. It'll phase out at 550,000, so you won't be eligible for this deduction anymore. It introduced a new term of qualified overtime. This is very important, and this is where the employer side, a lot of our construction clients or the employers, are going to have to be careful in tracking overtime pay, because qualified overtime means overtime compensation paid to an individual required under Section 7 of the Fair Labor Standards Act that exceed the regular employee rate. So, for example, under that act, it's normally defined as time and a half, so you have to be careful with that. Only the half, not the normal time, is eligible for the deduction. You also have to track it if you're subject to collective bargaining, because if you have an overtime rate that's in excess of that statutory limit, only the statutory limit, the half time, is what qualifies. If you're paying double time, you might not, the employee might not be able to get a deduction for that extra 0.5% that you're getting as part of an agreement. So there's a lot of tracking. It's going to require some tax forms, mainly the W-2 that you're used to seeing, to be revised, because employers are going to be required to disclose qualified overtime. On the employer side, you only have to disclose qualified overtime. That's another important piece. So you're going to have to start tracking the qualified versus just general overtime. So there is a little bit of an administrative burden with this one that I don't think a lot of people saw coming. So it's going to be an important piece to start monitoring and tracking once this goes into effect. And it applies to spouses only if they file a joint return. That wording's a little ambiguous. Basically, that means if you file married filing separately with your spouse, you give up the ability to take this deduction. It can only be claimed on single head of household and married filing joint returns, not a married filing separate return.
So Joe, one thing, withholding is not affected, right? So
correct.
Yeah.
So that's another piece. It's a deduction on the individual return, so it doesn't affect withholding, and the wages are still subject to Social Security and Medicare to the extent they normally would be.
Gotcha. So if you have a whole bunch of employees coming, well, now you have to adjust my withholding. You don't, because they deducted on their individual return, right? So they have to wait till they file their return in order to get this benefit. So that's one really important piece that people, at least your employees, need to understand. So overtime, and like I said, it's not all the overtime. There's a very specific requirement, and the only issue that the employer has to do is make sure that you report it correctly in the W-2, so they can figure out how to deduct it when they do their tax return.
Car loan interest, another campaign promise that was delivered in this one, is there was previous rules where personal interest expense is not deductible. So if you have a loan on your personal vehicle, you don't get any benefit of that interest from a tax perspective. Under the new rule, there's a new above the line deduction, again, temporary for tax years 2025 through 2028. It's going to allow individuals to deduct up to $10,000 of their interest every year on a car loan that's used to purchase a new vehicle in 2025 or later. Important, it does only apply to personal use vehicles. It doesn't apply to anything any pre-owned or fleet vehicles or to leases. Here's another piece that's kind of important. It applies to cars, minivans, vans, etc., but only if the final assembly occurred within the United States. That wasn't highly publicized when the bill came out. It is only for vehicles where that final assembly does occur here, not abroad. This deduction does phase out for $200 for each 1,000 for which your modified adjusted gross income exceeds either 100 for single or 200,000 for married filing joint. So with that, a complete phase out would occur between 150,000 or 250,000, depending on your filing status. So it's kind of a narrow margin on this one where you're actually going to be able to benefit from it. You have a $50,000 range and then it's gone. So it's there, but I imagine this will be significantly limited for many people when their income gets that high. So.
And Joe, we just had a question on the overtime pay. It looks like Don responded to it already, but just wanted to bring it up. That deduction for the overtime pay does start in 2025. And then we had another question about any insight on when the new W-2 form might be drafted to show the overtime versus standard time payment. I mean, those usually don't get released until very close to the end of the year, if not January. So I wouldn't expect that anytime soon. I would say the earliest probably November, but probably not, before close to year end.
I would advise just start tracking it with your payroll system, and then we'll figure out how to report it on the forms as the IRS releases additional guidance. A lot of this is hot off the press, and I imagine the IRS will be issuing additional guidance in the weeks that come.
And Kim, Don answered because he actually wrote a kind of a one-pager summary, a little article on this, which we're going to kind of release. We will release this week, so everybody on the call is going to get it. Explains it in real detail exactly what Joe said, and is going to explain the differences between how the overtime pay is being affected. So everybody will get a copy of that article this week.
Yep, and then one more question came in on the car loan for personal vehicles. How can you find where your car was finally assembled? Alex, if we circulate a PDF of these slides, I'm 99.9% positive that those words "final assembly" is a link where you're able to look up where your vehicle was finally assembled. So if you click on those, once we circulate these materials, you'll be able to click on that, and that should give you the information you need. So I'm not sure if I forget the link off the top of my head, if that was a reference or if it was actually where you could look it up, and I think it might be both. So
I since I'm sharing my screen, I can't get the link, but if one of you has it up, just feel free to throw it in the chat, but I can also include it in the follow-up email to this. So
yep.
And Joe, real quick on that, according to Google, the VIN number may give you indication where the car is assembled. So.
No, absolutely. Yeah, thanks, Don. There's ways to look up vehicles and where they're manufactured. So
yeah, for some of the electronic vehicle credits that were out there previously, they had similar requirements for it having to be assembled in the U.S. So the information is definitely out there.
Yep. I think that's it on the car loan side of things. Okay, charitable deductions. So individuals who itemize can deduct cash gifts to qualified charities up to 60% under the old rules. That was set to expire in 2025. And obviously there's no charitable deduction for individuals claiming the standard deduction under the current rules. There was a temporary one back during the COVID years, but that got removed. Under the new rules starting in year 2026, individuals who claim the standard deduction can deduct charitable contributions up to either $1,000 if you're single or $2,000 for married filing joint. Also, for those who itemize, there's a permanent extension of that 60% limit, but there's a new floor limitation, which means you have to exceed it before you get a deduction. Charitable deductions starting in 2026 will also only be deductible to the extent they exceed 0.5% of adjusted gross income. That disallowed portion, it's a little quirky the way they did this. That 0.5% is disallowed permanently. It only becomes a carryover if you're subject to the 60% limitation. So if you're subject to the 60% limitation, you get that 0.5% back to use in future periods. If you're not subject to the 60% limitation, that floor is lost forever, similar to how it is with medical, if you're familiar with that right now. So it's a little quirky. They put in a lot of rules for that, and I'm not really sure why, but the big win is if you take the standard deduction, which most taxpayers do now with that increased standard deduction we talked about, you are going to be able to deduct charity on top of that. So next slide, Alex. Okay, so our catch-all slide, some miscellaneous other provisions that they threw in there for individuals. It permanently extends the maximum child tax credit from $2,000 to $2,200 per qualifying child. That amount gets adjusted for inflation. That starts in 2025. That credit is still phased out. It's phased out for incomes exceeding $200,000 if you're single or $400,000 if you're married, filing joint. So that credit will continue to be available. The home mortgage interest, the current limitation is you're allowed to deduct interest on an average of $750,000 of mortgage debt. That's permanently extended. That limitation is going to be there. Some mortgage premiums are treated as qualified interest starting in 2026. So they expanded it a little bit, but they made the limitation permanent at the lower limit. And then a favorable change on 529 plans. It expands the permissible types of expenses that are treated as higher education expenses. So now that can actually generally include some elementary and high school expenses as well, like AP exams, SAT, ACT, tutors, educational therapies, and so on. So, and that's for all institutions, public, private, religious. So that's a much broader ability to use those 529 funds. Next slide, Alex. And some more provisions. Personal casualty losses, those rules didn't change. They got permanently extended. So you're able to claim an itemized deduction for casualty losses in federally and state declared disaster areas. And then this is a bigger one. This is not as highly broadcast either. Wagering expenses. For those of you who like to gamble, it permanently allows gambling losses after 2025. That was set to sunset. But it's still only to the extent of gains. You can't take a deduction for your gambling losses unless you have the gains to offset them. But you're only able to take 90% of the losses during the year. So that's a bigger change than usual. You can't offset dollar for dollar anymore. You now have a 90% limitation to worry about. So, slide. And now I think that kind of wraps up the individual piece. I think I'm going to turn it back over to Peter to talk about some of the clean energy and manufacturing credits.
Yeah, I want to briefly go over because a lot of these apply if you have contracts that are related to wind energy or solar energy or anything you're doing for your own jobs, right? That you might be have a contract for. So in this particular bill, there's a lot of these clean energy and all these provisions that Congress had made to incentivize companies to either invest in clean energy projects or tax credits related to that are really being phased out. So this advanced manufacturing tax, credit that was available, it's no longer available for any wind energy or so, that is produced after December 31st, 2027, and then it's being phased out again. Might not affect you directly, but it will affect maybe some of the contracts that you have. So let's go to the next slide. Talks about some of the other ones. The clean electric investment credit, again, wind and solar facilities that are placed in service after December 31st, 2027 are going to be phased out. The clean electricity production credit is going to be phased out after December 31st, 2027. And then after July 7th, 2025, facilities that were falling under Section 45Y, like Section 45E, are not going to be applicable anymore. So again, maybe it might not affect you personally in the sense of, credits in your individual return, but it will affect, any jobs that you might have down the pipeline or real after this date. So the next one might be one that will affect you, which would be, in some of the credits that you were getting for the next slide, sorry. Would be the commercial vehicle credit, right? Eliminates the credit for vehicles acquired after September 30th, 2025. So if there's any investments you were making in your business to get some of these commercial vehicles to as part of your fleet, it doesn't apply anymore. Also, alternative fuel vehicle refueling property credit is eliminated after June 30th, 2026. Energy efficient commercial building deduction of 179D. So there was this deduction or application that were three components of a building, right? The envelope, the interior, and I think it was the lighting. And if you met certain requirements and you had actually bought the building or you had the building done, you can take an immediate deduction based on some very specific calculations. Well, that is, being phased out completely. Again, it might not affect you directly, but it might be affecting the amount of investments people are making in the energy efficiency of a building, right? And again, advanced manufacturing investment credit, semiconductor, that's being it is affecting it. But again, it's one of the small ones that is. We have Lynn Keck from our office, who is an expert in these energy credits. If there's any consultation you need or any questions, we can follow them over to them. The purpose here is just to let you know which ones are from a perspective of any investment you're making in commercial vehicles that can be phased out. And then also when any contracts that you have that might be in your pipeline, how they might be affected if some of these energy credits are no longer available. So I think that kind of wraps it up for us. We did the best we could in about a 50-minute or 60-minute to give you as much information as we could based on the new tax bill. Again, I think, obviously from this discussion, there are things that we probably need to understand a little better, the ALF and the ILF on the 460E. How do we also change the accounting method? Is there going to be an extra form we need to file, or is it just going to be changing for any contracts that we have in place starting in 2025? So even though there's some questions that are still outstanding, I'm sure some of those will be resolved by year end, or at least we'll be able to take a position from a tax perspective as with them to determine how we're going to manage some of those things. And again, we urge you to reach out to any of us, from your team. We will be incorporating any of these provisions that apply to you, obviously, as we do year-end planning, specifically for the third quarter, and when we look at the end of the year specifically. So we'll help you to make sure that any tax benefits that you get, are realized now, to make sure that you can lower your tax bill. Don, you got a comment?
All right. First comment is great job, guys. As Lou mentioned in the chat, great job, construction tax team. I just want to do a quick shout out, quick reminder of, some of the other stuff that we can do that can kind of tie in with this as well. A lot of our contractors are beginning to outsource more and more of their services to us, their internal accounting. And one of those things that really ties in well to the new bonus depreciation, Section 179 planning, is when our OASIS team can handle the quarterly fixed asset updates for our contractors. Most of them typically are equipment heavy. So if we can do that for our clients on a quarterly basis, track the gap and the tax basis, it makes tax planning year end go much, much smoother. And the other thing that came up that Joe mentioned was the change in the estate and trust planning for the limitations. That is not as much of a big of a focus right now, but do still keep with them in mind if you need evaluation for anything. Besides trust and estate planning, if you're thinking about selling to a third party, you want to value your business, thinking about ESOP, gifting shares to family, or, God forbid, if there's a divorce or anything. If you need a business valuation, if you want to know how much your business is worth, keep with them in mind. We also have a great valuation team. So just wanted to chime in there, let everyone know about those.
Yeah, perfect. No, great, Don. Yeah, there's a slew of things that we can do to help you that will make, either the transfer of the company efficient, on an exit event, succession planning, all those things, and especially from an accounting perspective to make sure things are up to date. So, Don, I appreciate you reminding us of all those additional items that we can help, certainly everyone on the call. So thanks again. I think most of the people here that are on the call, either our clients, or if you are, a bonding company or an agent or someone else, you have our email addresses. Please feel free to reach out. If you have any questions, Alex will make sure that everyone gets a copy of the slides. And if you want a copy of the recording, we can also provide that for you. So thank you very much. We hope to speak to you soon. Thanks, guys. You guys did a great job.